Welcome back. You're watching us here on Halftime Report. Bottom of your screen, important flashes coming in as the street awaits clarity on who gets what. Subramaniam Jaishankar, as we know him, likely to retain the Ministry of External Affairs position. So that's news that is coming from our correspondents. We'll try and get more details on this one, apart from all the other that we're awaiting right now as well. And as we do that, let's also focus on some individual names. KEC International is a stock on our radar. The company has secured orders worth nearly 1,000 crores, a little over 1,050 crores. And the order intake in this year so far has crossed 3,000 crores. This year, as in this financial year. Vimal Kejriwal, who is the MD CEO, joins in now. Thanks a lot, Mr. Kejriwal, for joining in. Always a pleasure speaking with you. Remember the last conversation we had, you had fallen short of the 20,000 crore order inflow guidance for FY24. And you upped that by saying that this year, FY25, you'll get 25,000 crores. We're not even done with the first half of the first quarter, and you've done 3,000 crores already. So just wanted to know if 25,000 crores is still the target, or you'll do better than that?
I think we'll still stick to 25,000 as of now. 3,000 is orders which we have got spread across civil, railways, transmission. We still have a large 8,000 crore L1 with us. And these are mostly orders which are, which will happen now that the elections are over. Many of them are awaiting approvals and announcements. So we are, I think, comfortable with 25,000. Do we want to up it? I think it's a little bit early for that.
Okay. And you're sticking to that guidance of around 15% revenue growth in FY25. Is there any upside to this also?
Difficult to say today. I think it's, again, I'll say a little bit early. Let's see how the ground realities shape up. How do the supply chain issues, get resolved? Supply chain issues get resolved. We'll see if we can do more. But otherwise, I think it's a fair number which we have given of 15% increase.
Just wanted to understand that what is taking place in the railway business, because you all did have some challenges there when it came to execution delays, some kind of supply chain constraints. Are you expecting that to probably iron out in FY25? What's the on-ground situation there and your guidance on the segment?
Ekta, what is happening is that most of our old projects, as we call legacy, should now be getting over slowly one by one. So that part will get over. We have started securing orders. In fact, if you look at the orders announcement which we made, 1,061 crores, that's almost 40% of railway orders. One is for conversion, gauge conversion, and one is for power supply to metros. We do expect that with the new ministry coming in, and with a little less focus on political gains, I think we'll see a lot more spend happening on infrastructure, and also focus on completing the infrastructure project, which should help us in sort of clearing up the issues which are stopping the execution. So we do expect that railways should start turning around this year.
Railway turns around this year. Also, the SAE business, which turned around last year by being a bit positive for 4 quarters in a row. You expect that momentum to continue. With all of that happening, would you, hold on to that 7.5% to 8.5% sort of guidance? Would you believe that it will be closer to 8% this year in margins?
So, Mangalam, SAE was PBT positive all 4 quarters last year. And yes, they have an L1 plus order book of almost 3,000 crores. They are well placed. We had a very large auction in Brazil this March. And we are very well placed with some of the developers. So I think SAE should do well. I think our guidance right now is at 7.5%. And I think I'll come back to what Ekta was talking about, whether you want to stick to 15% or not. I think both of them are tied together. If you are able to push more execution on the newer orders which are coming at a better margin, then obviously there could be an upside. But I think as I said, I'll wait for some time to comment on that.
What is the downside risk to this guidance? What are you probably most concerned about going into FY25, which could be a headwind for you all?
So downside risk, I think, continues on the geopolitical side. Although we have factored all the Red Seas, etc., into this, most of our metal exposures are hedged. I think the only piece which is unhedged for us remains steel, which is not very easily hedgeable. So if suddenly, let's say, the steel price shoots up or something like that else happens. Otherwise, I think this year we are pretty comfortable with our numbers, both in terms of revenue growth as well as margin growth. I don't see, honestly, any big risk for these numbers.
What's your L1 position right now? I mean, the last time we spoke, it was 5,000 crores, of which you've got 3,000 crore worth orders coming in already. What does it stand at now?
So you're talking about the L1 position. We are at 8,000
Yes.
crores now.
8,000 crores.
And if you could, we are at 8,000 after this 3,000. Okay.
Right. So, and what's the breakup of these orders that you have, or rather L1 positions that you have right now?
So they are all in the transmission T&D sector. Everything. I think roughly half of it is in India, or slightly less than half of it in India. The rest is international.
Okay. In terms of the international segment, Saudi Arabia, UAE, USA, which would probably be the geography that you're expecting the highest growth from? Because you seem to be quite, bullish on this international T&D prospect. So within the geography, which one do you think you're probably going to bag the most orders from, which you're bullish on?
So it would be between Saudi and UAE. I don't know which one will get more orders, but between the two, I think we should get a lot of orders. US, there's a huge market, but for us, it's a supply market. So it's constrained by what I can supply to them. Otherwise, I can take more orders in US, but I don't think I'll be able to do too much more in US.
Right. And just before we let you go, you did give us a breakup of what your L1 position is right now, all of them nearly T&D. Of this 25,000 crores orders that you are expecting in this year, what would the breakup be? What comes from what segment and then materializes into revenue? So the mix?
So broadly, 50% of this, or maybe slightly more than that, will come in from T&D. So 12,000, 13,000 crores would come from T&D. Another 7,000 would come from civil. And the balance would be split between railways, cables, and renewables.
Okay. All right, so we're going to leave it on that note. Thanks very much for joining in and talking to us. And I'm sure we'll touch base with you to get a sense in terms of how the year is progressing and whether you're sticking to that guidance or not. Thanks very much for joining in. That's KEC. The stock is doing well today, up around 5.5%. We'll take a short break. On the other side, we'll focus on some more stocks which are buzzing today. Stay tuned.